Want to learn something new today? Join my Red Talk. That's a real estate discussion. Hey everybody, today's the day to learn something. Let's talk about how to calculate that mortgage payment so you know exactly what you're paying every month. So when I was younger, so much younger than today, I digress. So when I was younger, I had a difficult time grasping how to calculate a mortgage payment exactly. Have you ever felt that way? Let's talk about it. So a mortgage payment is broken up into typically five different parts, sometimes four. Most people, it's five. Let's talk about those five pieces of the puzzle and what you need to do to understand each. So, the first two things and the most common things we think about when we're calculating our payments is the principal and the interest. So, let's talk about each one of those. So, your principal is the amount of money that you actually finance. So, whatever the price of the house was minus your down payment, that's your principal payment. Now, that number starts off really small, and the more payments you make, the more principal you're putting, the more money you're putting toward the principal balance of your loan. Now, your interest is exactly what it sounds like. It's the amount of money that your bank is charging you or your lender is charging you to use their money to buy your house. Now, when you make your first payment, that number is generally really high. And just like your principal, it works inversely. The more payments you make, the less interest payments you're making. So let's assume a 30-year fixed rate mortgage at 7% interest. It's going to take you about 20 years of making the same consistent payment every month in order for you to start paying more principal on your loan than interest. So simple enough on the principal and interest. Now we're going to talk about what's considered your escrow payments. Now, escrow is basically a forced savings account. So we talked about in another video, we talked about how your bank pays your taxes and they pay your homeowners insurance once a year. Now, in order for them to do that, it becomes part of your monthly mortgage payment. So you pay your principal, your interest, you're going to pay your taxes, and you're going to pay your homeowners insurance all in your mortgage payment. Now, in order to make this all work, if you remember back when you closed on your house, you paid several months ahead of time on both your taxes and your insurance. Now, the bank does that specifically, your lender, I call it the bank lender, they do that specifically so they have a little bit of a cushion. So that way, when your bill comes due, they have enough money to pay for it. Now, with that being said, let's talk about how it breaks down each month. So, simply put, whenever you pay your mortgage payment, 1/12 of the amount of your taxes gets paid into your escrow account. So that way, when you pay 12/12, that's 100%, you have now paid your entire tax bill for the year. Your lender writes the check, and then your tax bill is paid. Yes, 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 yes. It is the same thing with your homeowners insurance. You pay 1/12 of the amount of your homeowners insurance every month into your escrow account. So that way, once a year, your lender, they write the check, your homeowners insurance gets paid. Now, I know you've heard a lot of people say, well, if you buy a house, your mortgage never changes. That's only partially correct. The principal and interest never change unless you refinance your loan. What can change is the amount of taxes that you pay and the cost of your homeowner's insurance. So, for example, the year after you buy your house, there's a better than average chance that the valuation of your house is going to go up. And if that happens, then your mortgage payment is going to go up because your escrow amount is going to change. Does that make sense? Same thing with your homeowner's insurance. If your homeowner's insurance goes up, then what's naturally going to happen is your payment's going to go up. Now we've talked about the four major parts of your payment. Now let's talk about the one thing that not a lot of people talk about, private mortgage insurance. Now most loans that you take out is going to make you put private mortgage insurance or PMI on the loan. Now PMI is a insurance that you're required to buy if you put down less than 20%, and it protects your lender in the event, and I know this isn't going to happen, in the event that you stop making your payments. So just to reiterate, it is added to your monthly payment if you put less than 20% down when you're buying your house. So your lender has a rate that they assign to PMI based on several factors that we would have to talk to a mortgage person to make sure we understood those pieces. But it can be as low as a 0.5% all the way up to 1.5%. So what they do is they take the original amount that you borrowed, they multiply it times your rate, they divide that number by 12, and that's your monthly PMI. So let's use an example. Let's say that you've financed $400,000 and the PMI that your lender is charging is 0.8%. So in that situation, 400,000 times 0.8 gets you the result. Then you divide that by 12. So your monthly payment would be $266.66 until you get to 20% what's called loan to value. So if all you do is make your minimum mortgage payment, you don't get a revaluation or anything else, PMI will generally fall off sometime around year 13 based on the scenario we talked about above, $400,000, 30-year mortgage at 7% interest rate. All right, so we talked about the 5 parts: principal, interest, taxes, insurance, and PMI. So how does all that add up to get to your mortgage payment? Let's put an example on the board. Okay, so you're sitting down to write your first mortgage payment. How's all that adding up? Let's talk about it. Here's the numbers. Your principal is going to be $327.88. Your interest is going to be $2,333.33. Your monthly homeowners insurance is going to be $250. Your monthly taxes are going to be $233.33. Your PMI is going to be $333.33 for an all-in monthly payment of $3,477.87. So do you want to know more? You want to ask some more questions? Comment below, like, subscribe, do all the things, and just thank you for coming to my Red Talk.